Okay, as far as the syllabus is concerned, you can read through this. The Zoom meeting's on there too. Should be the same one as today. And the textbook, any version of it you want to get is fine with me. We will be doing some problems out of it, so you know. But the any version of the textbook is fine. You do not need to have the code to do the problems, but the textbook is, I think it's been out for a little while. It's a couple years old, so you may be able to find a few that you used online if you want to get a loose leaf copy of it. Okay, blah blah blah. Grading for the class. 80% is the textbook problems, cases, modules, handouts, all that kind of stuff, and the exams are 80%. So basically what we'll do is we'll get done with a, with a chapter. In this one, we're gonna lump a few of the chapters together. The first few chapters are kind of definition-y kind of stuff. It's not terribly difficult. As we go on, we're gonna start doing a little more of the calculation stuff, which is gonna take a lot longer, obviously. But anyway, so we go through the parts of the chapters as we go along, and then we'll have a test after each chapter. And the reason for doing that is generally people do better with more tests, and they also retain more with it. So okay. This is an important one. The due dates on the tests, or anything, any of the assignments or anything. After the due date, those get included with your grade to date. However, you can still turn them in. So if you didn't turn it in on time, that does not mean that you can't still turn it in. So I do take late assignments. I don't take any points off of them, but obviously there won't be a grade in there until you do turn it in. So for instance, let's say that the chapter 1, 2, 3 exam is due on Friday or whatever. If you miss that date, don't think you can't turn it in. You can. You get full credit. But when I put the grades out, until that goes in, your grade's going to look really bad because you don't have that test in there. So even though there are due dates on these, truthfully, you can turn them in all the way up to the end of the semester, but it won't be in your grade, obviously, until that happens. So you're saying, why is my grade so terrible? If you're missing assignments, it is going to look terrible if you pass the due dates. But you still can get them in. There's nothing wrong with turning them in late, other than it won't be in your grade until you do. Dropping class, blah blah blah. Grading scale, we should probably use to. And here's the chapters and exams that we're going to have. Might alter this a little bit, but this should be pretty much. And again, the reason why more exams and smaller exams is that people generally retain more, and you usually score better on the exams. Any questions on that? So for instance, today we're going to do something else. If we go into assignments, today we have this. This is the chapter 1, 2, and 3 handout. We're going to do this today. And this is where you would submit it. And all of the things that we're going to submit will be in here under the assignments. So this one's for today. Obviously, hopefully we'll get through it. I think we should be able to. A couple things here. There's also the links here for the different programs. So, and I just put it here for your convenience. So if you want to open up Office Word or PowerPoint or any of those kind of things, if you just right click them, actually I think you just click on these, it'll open it. And so it'll open up in the web-based one. So that's where all your, those things are. Too much else. Okay. Oh, I'm sorry, there's one more thing I gotta cover here. The policies, and you guys have probably already seen this, policies and resources. And this has a lot of good stuff in it. If you need help in any way, there's a lot of things on here. People to contact, your contacts on that are all here. It's a good document to hold on to, just in case you need it. And it's always going to be there in Blackboard. So, any questions so far? No? Okay. All right, well, let's start looking at the chapter 1 and no, chapter 1, 2, and 3. I'm sorry. And basically, this first one is the first 3 chapters are kind of getting you aware of kind of what the problems are in international. When we do international accounting, what kind of things do you run into? And so that's what kind of the whole thing is. Now we start out. With. Sorry, lost here. So let's open up the chapter 1, 2, and 3 handout. By the way, the handouts are. So it should look like this. The handouts are given in PDF and in Word form, and you can use either one. And as far as turning in the handouts, when you submit the handouts, you can submit them. I'll take almost any way that you submit them, with 2 exceptions. If you can type right into the handout itself, save the file, and submit it. So you can put it right into either the PDF document or right into the Word document, and that's fine. You can do it that way. If you want to print it out and write out and take pictures of it or scan it, you can do it that way. You can also just write it in notebook paper. So if you just want to write it down in notebook paper, with the answers or whatever, and then either take pictures of it or scan them and send them in, that's fine. So however you want to turn it in is fine with me. And in Blackboard, you have unlimited submittals. So if you take 10 pictures, you can submit 10 pictures. There's nothing wrong with it. The only 2 kind of files that you cannot submit are zip files and page files. Zip files are for Word. It's mean they take all the different files and lump them together. Blackboard can't handle that. It doesn't know what to do with them. And same thing with page files. Page files are what they use for Apple stuff. You can't turn those in Blackboard. It doesn't know what to do with them. So zip files and page files. Now, do I wish Blackboard handled those? Yeah, but they don't. So if you take 5 pictures, don't zip them, don't put them into a page file, just submit them individually. It's absolutely fine. There's no problem with doing that. It's unlimited submittals, and Blackboard's happy, I'm happy, you're happy, we're all happy. So just don't use zip files or page files. Everything else, any other way you turn them is fine. Okay. So what we're going to do is start out with our financial statements. And we're going to do a couple of them just to kind of remember exactly the order of them, because we're going to run into some that are kind of wacky and we want to kind of know the difference of them. Okay, what do we start out with on our income statement? Anyone? Oh, come on. Income statement, we start out with money coming in. Which one of those looks like money coming in? Yeah, you guys are sleeping, aren't you? Okay. Close. They'll end up in retained earnings, but we're going to start out with revenues. So here we have revenues. And revenues, we have 22,500. So this is all the money that came in. And to figure out how much income we made, we will also look at what money went out. Now, luckily for us, the accounting terms is basically our same terms that we have, and that is we're gonna have expenses. So your expenses are money going out. We're gonna have wages expense. And I'm gonna put that in as a negative. And then also utilities expense. And so income statement really is just what money came in, what money went out. That's all it is. So $22,500 came in. $4,000 and $8,250 went out. So what's ever left over, we're gonna call our net income. Time for Mr. Calculator. You can use the Excel too if you want. $10,250. Yep, very good. Makes sense. All right, so let's see here. I'm gonna try switching cameras, so this might not. This may or may not work. See if I get okay, retained earnings. Retained earnings is kind of like a piggy bank. Yeah, rustling you hear me trying to find a pen. Okay, so piggy bank. So this is kind of like a retained earnings. So okay, so we have our piggy bank, and income goes into the piggy bank. So this is sort of like the owner's piggy bank. So the net income goes into it, goes into their piggy bank. When they take money out, they take it out with dividends. Okay, so what goes into the piggy bank is net income. What comes out are the dividends. So all your income, your revenues, expenses, all that kind of stuff goes into your net income. It does go into the retained earnings. So it is part of it. Okay, so this net income is going to go up here. Now, retained earnings, we actually have something in retained earnings already. How much do we have in retained earnings already?
12,500.
Yep. So retained earnings. So I'm gonna say that getting retained earnings. Okay, so 12,500. Let's make that a different color. Let's make that 3. Now our net income is going to go in there also. It's going to go into our piggy bank. So okay, so it's sort of like this. We have the 12,000. We have 12,500 in our piggy bank. We just added in. I think it's 10,250, wasn't it? I can't remember. So 10,250 is going in to our retained earnings, and we're going to take some out with the dividends. Okay, so the dividends they took out were how much?
1,000.
Yep. Say cash deficit. And put that as a negative because that's money coming out of the piggy bank. And then we'll end up with what our ending retained earnings are, what's left in the piggy bank. Oops. Let's see. Yep, yeah, 21, yep, 21.7, that's what I got. So this is what's left in our retained earnings. Okay, so they still have 21,750 in the retained earnings. And by the way, just I know this kind of belabor the point a little bit here, but the you'll notice if there's nothing in the piggy bank, you can't take anything out. Right? You know, pick up 1,000 here. But if the piggy bank is empty, if there's nothing in the piggy bank, you can't take anything out. So if you're wondering why, why does it go in the piggy bank and then come out, is because there had to be something in the piggy bank, or else they can't take. Okay. So it's the income statement, statement of retained earnings. And run off the balance sheet. And okay, so balance sheet. We have assets, and assets are anything of value. Okay, so looking at our accounts here. What things have value? I'm gonna tell you
Cash
what,
and equipment.
yep, cash, equipment, and I was gonna include accounts receivable. The common stock is something a little bit wacky, which I'll talk about. But these three. According to those all have value. Cash is valuable, obviously. Accounts receivable is gonna turn into cash, so this 3,000 will eventually become cash. So we count that as a asset, and this equipment obviously has a value. Okay, so cash, accounts receivable, okay. Just that quick, I forgot, 3,017. Okay, so these are all. Assets, they have a value. Oops. Total goes up. I think it's 25,000. Sort of 17, that's, yeah, I think it's 20. Okay. Now we have two more accounts that we have to take care of, common stock, accounts payable. Liabilities, this is when you owe. And which of these last two accounts is probably going to be a liability? We still have common stock left and accounts payable.
Accounts payable.
Yep. $12.50. Okay, well, the equity section. The last one. Common stock. So common stock, my place. Common stock is actually the owners of the place. The equity section, and this is for the owners. What do they own of it? So we have stock 2,000. Now, we still have one more thing, though, that these owners have that we have to put in here, and that is their piggy bank, retained earnings. You know, this thing, this is the owner's piggy bank. So this has whatever the ending balance in the piggy bank is. That belongs to the owner. So we're going to put it in with the owner's stuff. So any retained earnings is 21,750. What the hell if I can make an arrow from one page to the next? Let me try. I don't think it's gonna let me though. Nope. Well, anyway, this retained earnings is the same as this retained earnings up here. I know what I can do. I can make this one move down some. At least getting closer. Ah. Okay, so anyway, this. It's so close. It's tantalizingly close. Yay, we did it. So this retained earnings is this same retained earnings down here. Could zoom out a little bit, that would help. So these two are the same. So this retained earnings is the owner's retained earnings. So the total equity are those two together, which is 23,750. And if we add these two together. We add these two together. We should get the same as over here, and we do $25,000. So these two need to equal, and they do. Now you might be wondering, well, okay, they equal, what does that mean? And what that means is. Let's see here. What that means is this, you get all these assets, this is all stuff that you have. So these are all your assets, and the question is, how'd you get them? They have to come from somewhere. You know, these have a value, they have to come from somewhere. So how did you get these assets? Well, you borrowed 1,250. And the owners kicked in the other 23,750. So all the balance sheet does is tell you where these assets came from. Where they come from, you borrowed this amount. And the owners kicked in that amount, and that's how you got those assets. So if you're wondering why it balances, that's why it balances. You have to explain how you came up with those. Question on that? Okay, let's go to the next one here. And I don't think there's too much. There's a couple new things here. What kind of account do you think inventory is?
An asset?
Yep. Yeah, it has a value. We already had those two. Accounts payable. What kind of account do you think mortgage payable is?
Liability?
Yep. Yeah, all payable are gonna be liabilities. Oops, not spelled that way, but. And cost of goods sold is gonna be with it goes with the expenses, sort of like an expense. We call it formatting, but So see if you can figure this one out. So go ahead and try to do the income statement, statement of retained earnings and balance sheet. Okay, I think this is what you should have for the income statement and retained earnings. We want to check my answers. Because I'm frequently wrong, but yeah, I think that's it. Let's go to balance sheet, and these are all. Are all the wrong color right now. Hold on a second. Try it again. Okay. These are all assets. So cash is a value, accounts receivable has a value. Inventory, as I said earlier, is an asset, and equipment is too. So all three of those, all four of those. Really. Thousand. There's a better way to do this. They'd be on the same page. Inventory is 5520. Equipment. 38,800. That's wrong. I'm sorry, 36,000. Let's try that again. Okay. $51,520. Sure. And so then we have to tell people, well, how did we get this? We have $51,520 worth of stuff. And now we have to explain how we got it. So this other side will explain how we got it. Accounts payable, mortgage payable. $300, 11,500. Okay. Okay, so the 51,520, we borrowed 13,800. Truthfully, right now, we could figure out what the equity would be if we just subtract these two, subtract the 13,000 from that, we'd find out what it is, but. Let's go ahead and put the common stock in. $4,600. Ending retained earnings. $3,120. And we can, and so this is the total equity. Okay, then hopefully these two will equal. So. Okay. $37. Okay, so these two should equal, and they do. So how do we get all this stuff? 51,520 of the stuff, we borrowed 13,800. And the owners kicked in the other 37,000, so that's how where all this stuff came from. Any question on that?
No.
And I know you guys did this on your classes, obviously, but. So this is the normal way that we do accounting in the United States. And we're gonna find out that some other countries do things a little bit differently. But just to kind of give you an idea, coming down here, it says, suppose the above amounts were in Singapore dollars. And Singapore dollars equal 0.715 US dollars. How much would the cash be worth? Okay, so if we have this cash here. New plan. So cash is 8,000 Singapore dollars. We would have to multiply those times. Get US dollars, whatever that is. So 8,000 times 0.715. $5,720. So if this was in a foreign currency, so let's say that we owned a company in Singapore. And we do their financial statements like we're used to. It would show that we would have in US dollars, we'd have 5,720 US dollars. These are in Singapore dollars. But this would be worth in US dollars. Okay, let's go ahead and take a break. I'll leave this up for a little bit. But let's say be back at, what time is it? 6:54 on my, let's say be back at, 7:05 about. Okay. Yeah, hold on a second, I better switch cameras back. Hey, I did it. Okay, so what we're gonna do is we're gonna start going through the other part of the handout. We'll see how far we get. Okay. So just so you know that when we talk about these international transactions, we run into two different problems. And the two different problems look like this: the exchange rates and the accounting methods. Foreign exchange rates, all countries have their own currency, or most of them do. The only real exception to that is the European Union. They have euros, but some of them still have their own currency. At least they used to. So anyway, the foreign currency exchange rate. Now let's take a look at. There's a Excel sheet that I sent with, and these are exchange rates as of August 22nd, I guess. And so there's two different exchange rates. One is $1 US dollar will buy how much of the other currency, and the other way around is how much of that currency will buy the US dollar. So when we go from a foreign currency to US dollars, this is kind of what we're looking at. These are usually the ones that we're actually going to use to convert it. And that looks terrible. Hold on. And you'll notice here's the Singapore dollar one that we just used. That's where I got the 0.715 for the credit. It's from that. So the end of the exchange rate, they change all the time. A lot of times these will change daily. Here's the top 50, and there's all kinds of sites that have these up. The exchange rates are sometimes they're called the spot rates. But so these are the foreign currency, the different amounts of foreign currency exchange rates. And I want to show you something though. So back to our handout. Let me go back to the handout for a second. So first of all, you can translate transaction into US dollars. So if you do a transaction in Singapore dollars, you can translate it into US dollars. Or if you do it in whatever, Canadian dollars or euros or whatever, you can translate it into US dollars. Foreign currency operations, you have to translate them from their to US GAAP, US accounting principles. And then also translate the currency. So you have to change their accounting system and also translate that into US dollars. And I just want to jump back, and I'm jumping around here. If you look on the tab that says foreign currency. So these are their foreign currency translations from their foreign transaction. Now, Ford has plants all over the world. They've had plants all over the world for many, many years. Excuse me. So this is not, it's not unusual. It's not a foreign, having large foreign operations is very common for a lot of companies. It's not unusual at all. So, but the changes in the currency can have an impact on US dollars. And you'll see here that, now these are in millions. So this is, they began 2019 with a loss of $4.8 billion for foreign currency. It changed throughout the year. At the end of 2021, they had almost $5.5 billion in foreign currency loss. The changes in the foreign currency changed the amount that they had on their books. Because these prices, these currencies go up and down. And sometimes these foreign currencies go up and down, not because of markets, but because of governments. It's not unusual for a government to devalue their currency, to make their currency worth less US dollars. And there's really two ways that comes about, but the strategic way is that countries will say, okay, if we devalue our money compared to the US dollar, that makes our stuff cheaper. Now, we can't buy stuff from other countries as well, but our stuff is cheaper. We can sell a lot more stuff. So sometimes it's an employment thing or whatever, they will devalue their currency. They'll make their currency less valuable than the United States, and usually the US is the benchmark, usually. So they'll devalue it, knowing that it's going to hurt their people somewhat because they can't buy imported goods as easily. But it's going to make their stuff less expensive. They're going to sell them. So that's one of the common things that happens. And by the way, in the European market, where they have all those countries have the same thing, the euro, one of the problems that they have is that they can't devalue based on one country. So one country would benefit from devaluing the currency, another country may not. So you losing control of their currency can be a real problem. Okay, so those rates fluctuate. There's also some governments that don't have a real effective tax collection method. So what they do is they just keep printing more money. They have high inflation, sometimes what they call hyperinflation. And in those countries, a lot of times, the minute you get paid in their currency, the first thing you do is go buy US dollars or some other more stable currency. Because you don't want to hold on to it if the value of that currency is dropping. I mean, if you hold on to that currency for very long, you're going to have half as much money. So a lot of times there's a rush to convert them into US dollars or some other more stable currency immediately. And it has to do with the taxing system. Okay. So these are all the rates that you can see for it. The one that really sticks out here, this one's a really sad one, is at the bottom. What's going on in Venezuela right now is no good. But yeah, so these are the exchange rates for at that point in time. And again, they can have a pretty big impact on a company. They can, here's like say 5 billion in losses, not for any business miscalculation, but just because of change in the currency, something they have no control over. Okay. Back to our handout. Okay, the accounting methods. The accounting methods from different countries, they've always been, every country's had their own, why is this funny? Sorry. Weird light on. Hey, look, it's me. I look like one of those, they like gave a flashlight underneath, it looks cool. Anyway, all these countries, they've all developed their own accounting systems. They're all kind of the same, but they have different things that are important, different things that have become their normal. Our income statement, we have revenues minus expenses gives us our income. Well, if you think about it, why do we have revenues first? Well, we just do. Okay, can you have expenses first? Sure. Yeah, there's different ways of laying things out, and sometimes they are in a format that may be unfamiliar to us, but that's just because that's the way they do business in other places. So, given that, one of the things that was really hurting world economies And especially countries that didn't have as developed of markets like we have for stocks and bonds and all that kind of stuff, where companies can get lending and investment and all that fairly readily, is that their accounting systems were different than ours. And we would not let them list their stock on our exchanges with using their own, okay, so we had this kind of weird thing happening where, we had these markets that could easily handle foreign companies, but there was all these kind of accounting system issues that came up. They kind of prohibited that. Now, what they tried to doing is saying, okay, well, maybe we can get all of the accounting systems, all the accounting, rules to kind of be similar between countries, or at least have a method that they can use. That, okay, you can still use whatever you're using, but you can use these international standards that should work everywhere. And that's kind of what they came up with. They're called the International Financial Standards. They're different than US GAAP standards, and they're probably never going to be the same, but they are kind of an attempt to standardize it, and they've done actually very well. International accounting rules have been accepted most places in the world, but the idea is that to try to get kind of a common set of financial statements. Okay. So US, we have our own principles. We use the ACCT. They are a group of CPAs, basically. The ACCT is it's just a club. When you pass the CPA exam, they'll invite you into their club. You pass the CPA exam, they'll say, hey, you're a CPA, you want to join our club, ACCT. Oh, by the way, we make all the accounting rules and we make the CPA exam and we do all these other things. But it's just a club. It's not a government agency. And you'll find that the other one, that the international ones are not government agencies. They're just, they're basically clubs that make these rules that are required by countries. Okay. Other countries. International Financial Reporting Standards, IFRS, commonly called IFRS. Oops. Papers just goofed up my thing here. No. Put IFRS back the way they were. Okay, so international standards. They talk about a convergence. And their convergence is really to work out how to best take any given, let's take a country, whatever, Bulgaria. Bulgaria has their own state accounting rules. Okay, how do you take Bulgaria and try to get them to be able to put it into the international standards format? And that's what they call about convergence, so that they can take their information, put it in a format, and the rest of the world can use. So now if you have a company in Bulgaria, you can have investors from all over the world, because using the same financial statements, they can read them and make heads or tails out of them and know how well you're doing. Okay. So in many of these companies, they have their own version of IFRS. It's not completely standardized. It's not completely converted. It's not all one way. So you do have a few things that are different among them. Okay, problems caused by accounting diversity. Now, this is not diversity as we know it. This is not people diversity. This means that they all have a diverse set of accounting rules. So what are the problems if they all have different accounting rules, and obviously the financial statements look different? You can't get into foreign markets. You can't compare it to other countries. So if you have a company that makes woodworking equipment in Bulgaria, you can't compare it to one that makes woodworking equipment in Germany. And lack of high quality accounting information. Depending on where it comes from, sometimes these it's less reliable. Okay. So these are some of the arguments for convergence, and I'm not gonna go through these. The arguments for them are obvious. And so we all have the same system, everyone has access to the same markets, it's kind of a equalization. Egalitarian, everybody's the same. Kind of a thing. There are some problems with it though. And the problems with them are a little bit more serious than, because you read this and you go, oh, well, we should all do that. Okay, there's a lot of different standards existing. And these have been used for years. The method that we're using in the United States has been around for about 400 years. So they have different standards. Their legal systems are different. And their healthcare. Actually, I'll talk about these two together. United States has the US legal system is way different than any other place in the world. You do not have legal systems in other countries where you have multi-million-dollar verdicts. It's against public interest. In the United States, someone wins, sues the city and they win $9 million, and everyone goes, "Yay, they win $9 million," but really that $9 million comes out of other people, out of the services of people who had nothing to do with whatever the lawsuit was about. Other countries have a different view of those sorts of things. In like our legal system in the United States, just putting a finer point on it, when we do auditing, if you do auditing in another country, a lot of times they don't even consult with the lawyers or the legal aspect of the company. There's nothing serious about it. They're not in a serious lawsuit. They don't really worry too much about it. United States, it's required that you contact the lawyers for whatever your client is. So if you're auditing Microsoft, you have to talk to Microsoft's lawyers. It's required. Why is it required? Because these can be hundreds of millions of dollars in lawsuits, if not billions of dollars. They don't have that in other countries. So, our legal system is way different. Our healthcare system is way different. I think there's only a couple countries in the world that have a healthcare system similar to ours. Most in other countries, they say, well, why are the employers paying for the healthcare? Why are they paying the healthcare insurance? They don't pay the car insurance. Why is it healthcare insurance that they? And it comes out from actually the United States comes out from World War II. World War II, they had a freeze on pay increases. So how do you get people to work for you? And you can't increase the salary. You give them free healthcare. And so that's what it came out of World War II, and then it just became part of the the standard. Before World War II, companies did not pay for medical for their employees. After they did, and back then, the costs were pretty low, but it was still they'd actually have doctors and nurses on staff at the company. People would bring in their kids, and whatever. So, healthcare is one of those weird things. Now it's billions and billions of dollars, that other countries don't have. So all of our accounting rules for okay. Oh, no problem. And by the way, you guys, these lectures are taped. They'll be posted online. So if you do miss one or you have to leave, that's fine. There's not a problem. But anyway, but these are the differences that come about. So, United States, you can have a company that they can have more liability and more assets wrapped up in their healthcare than the rest of the company combined. When I worked at Navistar, we had 11,000 employees. We had 39,000 retirees. We had more than 3 times as many retired people that we had to provide for than working people. You don't get that in other countries usually. So anyway, that's one of those really big things that makes that US different than other places. Tax systems are different. Yeah, let's go back to this handout here. I want to go back here. Corporate taxes by country. in this Excel handout. And so these are, I don't know how many countries are here, a lot. So these are the tax rate of the different countries. 200 and some countries here. And this is their corporate tax rate. And if you go to the next one here, corporate tax rate by rate, there are a lot of countries that don't have any taxes. They have no taxes. And this goes from low to high, and this goes from high to low, these two sides. Okay. And here is Microsoft. This last little thing here, this is Microsoft rates. And you'll notice that the US rate for taxes is 21%. But because some of their money is earned in other countries, their effective tax rate is a lot less than that. You'll notice the big thing here is foreign earnings taxed at a lower rate. So the different tax rates have a big impact on the country, on the companies. All right, and it's a huge part of planning. Apple negotiated to have a zero tax rate with Ireland if they had their headquarters in Ireland for the European market. And they had all this money, that they made from the European market. They wanted to bring over to the US. And when they bring it over to the US, it gets taxed at US rates. So they had something crazy like 130 some billion dollars in US, in equivalent US currency that they couldn't bring over because they would be taxed at 20 whatever percent. They'd have a tax bill of $60 billion or whatever it was. Okay. This last little part here kind of goes into the acceptance of the international standards. And there is a big difference between those two, and it's kind of in this one paragraph here. I have two paragraphs, I'm sorry. International standards are much more principle-based. So European standards and the international standard, I should say, they're much more, so you look at, okay, what are the characteristics of an asset? So is this an asset or not? So their approach is more based on the principles of it. The US is based on rules. And we have a, right, wrong way of doing everything. Nope, that is an asset. Nope, that's not an asset. Oops. Let's do something weird. Okay. So the US are have a very different system. Even when they try to become more principles based, almost always it kind of degenerates into, do it this way, don't do it that way, kind of a thing. And the problem with this is a lot of times you'll have things that slip through the cracks. For instance, a company is doing it the right way, but the right way kind of misstates the income. But they have to do it that way because it's put in the books that this is the right way to do it. Okay. Now, there is a very important thing in here, and that's this way here. We'll end on this. We'll end up a little early. Hope you guys don't mind that, man. All right, so this is a very important thing, and that is starting in 2007, that companies could list their stocks on the exchanges in the United States using the international standards, and they did not have to convert those into GAAP. So even though we still have GAAP, we still have our US GAAP, and we still use it quite a bit. Companies can use the international standards instead of US GAAP for their financial statements. And it's not uncommon for companies to use both. They'll put out two sets of financial statements. Here it is in GAAP, here it is in international standards. And they'll have two sets of financial statements for, everything, and they'll list them on different exchanges. We list on the US exchange and European exchange and so on and so forth. So anyway, those are the problems with the international aspect of it. You have the translation problem, translation of the currencies, the dollar. United States, if you get a dollar, it's a dollar. And over there, if you have, some currency in the bank, it depends on the exchange rate. So if you have one Singapore dollar, it might be worth something at the beginning of the year, it might be worth something completely different at the end. More or less, you may have more money or less money depending on what happens with that. With the currency rate. And in the accounting systems can be fairly different. I want to just show you, and this is in your book, and you can take a look at it. I think it's on page 40. Hey, log me out. This is on page 41 in your textbook. If you don't have the textbook, you can get it. You can look at this. But you look at these financial statements. And, they can be very different than what we're looking at. Here they have one for gross revenue. Oops. So this is, who is this? Brazil. Here is one from, this is US. So this is one we're used to seeing. Start out with sales or revenue. Subtract everything out, and you come up with your income. So this is one we're used to seeing in the United States. This is Germany. Germany's kind of interesting. I'll talk about it in a second. But Germany, this is their financial statement. Look at their revenues. The revenues actually has cost of materials in it. Expenses and all kinds of stuff. And come down here, read operations. I'll tell you one of the strange things about Germany is that United States, we say, okay, how much money did you make this year? How much did you make this year? Did you have a good year or a bad year, whatever? How much did you make specifically this year? We really focus on the income. In Germany, it's a little bit different. If you have a really good year, they say, oh, no. You had a good year, but that's because you have some bad years too. So you have to when you have a really good year, you kind of have to spread that out over, other periods. In the United States, you can go to jail for that. But in Germany, it's required. No. If you had if your profits were really big this year, that's because you're going to have lower ones later on, and they'll all kind of even out in the end. And you can't record it all at once. So completely different idea behind it. Two very developed countries, Germany, the United States, are both very mature markets and all that kind of stuff. Not that anyone's right or wrong, but it's just completely different idea behind it. Anyway, I think there's like 8 of them on there. You can take a look at them later. Maybe we'll talk a little bit about them. But again, very different ways of doing it, and not because of any, anything bad or anything like that. It's just that's the way that they, their values, the way they think. That's the way they invest in places. They say, okay, we need this, this, and this. And that's how you know about the investment. Completely different in the United States. Okay, so here's what we're going to do. So you have the financial statements done for the, sorry, you're not seeing my screen. Let's try that again. So this is done. You should have this done. And whether you did it on paper or on the handout itself, you can go and under assignments, you can go and then submit it. Yeah, right. Probably go to files, and you can, again, you can put on as many as you want. You can upload as many as you want because there's unlimited amount to upload. Unlimited submittals for all the problems. And also, I'll say one more thing, and that is, if you submit something, let's say you submit it and you don't submit it right, or you submit it and you realize you submitted the wrong thing or something like that, you just have to submit again. You don't need my permission for it or anything like that. And I'll see, it'll say, first of 3 submissions, say, 1, 2, 3. What I usually do is go to the 3rd submission and go, okay, this is probably the one that they want me to look at, and that's when I look at first. So don't worry about if, gee, I submitted the wrong thing or I submitted it wrong. All these lectures are taped, or they're videoed, and they are. It takes about a day to get them up on Blackboard. They will be on there. There'll be a tab that will say recorded Zoom meetings. Will be on there, and it takes about a day. And it takes about a day because once we're done here, it'll render it here. Once it takes like an hour. Then I render it again to cut to edit a little bit off the ends of it, and I have to do that. It's a YouTube thing, and then I put it on YouTube, and YouTube will put the closed captioning on it. So, and that's for the ADA, the American Disabilities Act, that you have to have closed captioning. So that's the reason why it takes a little longer. I try to get them in by midnight, but it doesn't always work out that way. So anyway, certainly within a day, though, the videos will be posted. And by the way, if you're wondering why I put out the handouts in both Word documents and then also in PDF files, it's the same thing as for the ADA. There are some things that the PDF files can do that the Word files can't. I don't know exactly the specifics of it, but anyway, it's the component of the ADA, the American Disabilities Act. So it takes a little longer, but it's worth it. And you can, if you want to, you can just have the sound off, listen to your music, and you can watch the captions if you want. Okay. Any questions? Any other questions? Okay, well, I hope you guys don't mind us getting out a little early today. And I will see you guys in a week's time. So the only thing to turn in is today's handout, chapter 1, 2, 3 handout. That's the only thing to turn in. Nothing until next week. Okay. All right. Have a good evening.
See you next week.
See you.
Thank you.
Thanks, guys.